Time to Prabhudas Leeladhar PMS is with us. Ajay, hi, good afternoon. Good to have you on the show. So, your thoughts on the kind of moves that we're seeing right now? A big rupee trade has played out with IT and pharma. You reckon more of that could play out?
Good afternoon, Anuj. I think, in my opinion, I think the surge of liquidity in the domestic market essentially has been propelling the index higher, and the rally sort of is basically IT and pharma stocks. The rise there is underpinned by falling rupee. In my opinion, I think the market is quite blasé about congruence of 3 or 4 global events, which will play out, in my opinion, in a month and a half from now. The spectre of worsening trade war between America and China being the first one. Secondly, I think the November deadline is looming on the horizon for many countries who are largely import from Iran. I think whether we get a waiver from America or some respite, I think that again should play into the Indian markets. And thirdly, globally, let's not forget that the yield curve has flattened the most after Lehman Brothers, essentially indicating that there is some sort of queasiness in the global markets about how the long-term economic growth will pan out. In Indian context, I think that is supplemented by the rising crude. Sort of the macros fraying at the edges, sort of playing into the vicious cycle of higher current account and trade deficit, imported inflation, and its impact on say debt flows to emerging markets. We yesterday evening saw what happened in Argentina on the back of what happened a few weeks back in Turkey. Let's not forget that we have a twin deficit problem on hand. There's also the undercurrent of political uncertainty with the December assembly elections not very far from now. People will start talking about the probable permutations emerging after the election results, maybe I think a month or so from now. So there's a whole host of domestic and global headwinds that the market is completely sanguine about and completely blasé, essentially because the liquidity is taking the market up. And this reminds me of that quarter, October 07 to December 07, when surge of liquidity, domestic and foreign, was propelling the markets at very high levels, and the market was completely sanguine. And then all of us know what happened subsequently in January 08. So I think I would caution investors to be very, very careful before committing large funds in the markets right now. This is the time not to be adventurous. This is the time to be very, very mindful of what franchises that you are buying. And I would urge investors to exercise that caution. Although I must say that on the tailwind side, I think the earnings recovery should gather steam in second half of this financial year, because the corporate earnings revival, which was on the horizon for last 3-4 years, finally one is seeing very strong growth in case of volumes, in case of retail franchises, automobiles, although one has seen some tepid numbers expected this month, but hopefully I think in the second half the FMCG companies, auto companies, retail companies should continue to post decent results. The cost push inflationary pressures also are being evident now have started becoming evident in many of these industries. So I think all in all, I would say that valuations also we are trading at 24 times premium. Nifty is trading off 1 year forward multiple. Our numbers show that the Nifty earnings a year from now, August 19, should be roughly around 550 rupees, and at 11,700 we are trading at around 24 times 1 year forward earnings, and last 10 years average is 17 times. So that premium has now widened to a good 24%. So I think all factors are pointing towards caution to be the buzzword and watchword. But then I think, as they say, in the short term, liquidity determines the outcome of the market.
That's true, Ajay. Take your point about the need to be cautious. Having said that, you're quite optimistic about an uptick in rural spending, and you cite a couple of reasons in your note. I mean, I perfectly get that. We're heading close to elections. There's been MSP hike, largely okay sort of monsoon in most parts, barring, of course, the excesses. Now, the question is, how do you play the rural theme, the rural prosperity theme? Would you look at two-wheelers? But there, I mean, we just went through the last month, or I think month and a half back, this whole thing about price wars, etc. Would you play it through FMCG? But then their, valuations are very high. So the kind of stocks that you would back then.
Yeah. So I think, as you said, I think the cost plus inflationary pressures are clearly evident in many auto franchises. And so although the valuations there are not forbidding in case of two-wheelers, but these pressures on gross margins is making us slightly worry in case of two-wheelers. I think our preference still remains with the passenger vehicles companies. One has seen some sort of a correction in a franchise like Maruti, where numbers are expected to be tepid in this month. But we are hopeful that as the year wears on, in the second half the numbers should pick up. And the stock also post correction can be looked at with a medium term perspective. We are also positive on the farm equipment sector, and Mahindra & Mahindra has been sort of our preferred pick now for last year or so. I think one should continue to look at that company with a medium term perspective on correction. In case of FMCG, again the volume growth is very strong. The rural demand in most of the franchises is around 4 to 5% higher than the urban demand as per many companies, and the aggregate demand impulses should strengthen in second half. So but there I think one needs to be treated with caution because valuations are very high. So company like Britannia on dips one can look at, or one can also sort of look at some of the retail companies to play, where again the valuations are very high. So in the short term, I think FMCG, auto and consumer franchises, both in the NBFC and the banking side, also are on our radar. So I think this is the bouquet sort of that one is looking at. In addition to that, consumer durables one can look at, sort of where the valuations are not as forbidding as the FMCG names.
Okay, well, lots of stocks moving once again. Let's just see the intraday chart on Adani Ports, not Enterprises. Ports is a stock that I'm talking about now. In the morning also there was a move, and now a bit of a fresh move starting on that one. Apart from that, discuss of course PSU banks. IDBI has now surged to the high point. Hindustan Zinc's been moving up. Petronet LNG, Pidilite has made a move, so that's also been quite interesting. And MRF from the tire space, that is the one which has seen sharp intraday reversal. Just see the intraday chart on an MRF. That's where you are right now, 1% higher on MRF. Ajay, thoughts on Reliance that's led this market rally? In fact, I think 300-400 points have been contributed by Reliance alone in the last 1,000-point rally thereabout. I mean, that's one stat that I had. You reckon it still has the leadership quality here?
I think I just came across some very fascinating analysis on Reliance about the price rise being too fast too soon. And I think if you look at the way sharp rise has happened, I think in my opinion, I think it is discounting sort of on an optimistic side the next couple of years of earnings, and I would sort of be quite cautious on Reliance from here on. And I think it would not be too bad if one sort of monetizes a part of one's holding in Reliance, having seen nearly 38 to 40% rise from 1st of July on a company of that scale and that heft. I think one needs to sort of trim one's positions in Reliance.
Okay, that's an interesting call. Profit booking on Reliance is what you're looking at. Ajay, okay, so where are you on this debate between corporate banks and the traditional favorite private retail banks? What would you buy now if you were to buy stocks?
Yeah, I think I would adopt a more balanced approach. Sort of in the last month and a half, I think all eyes have been on both private as well as public focused, public sector owned corporate banks. Basic underlying assumption being that there is a deceleration in the generation of slippages. It's a second degree derivative you are looking at, and that's why people are getting positive. And the fact that the recognition has happened, the balance sheet dent that it had to happen, we are already behind it. However, there could be some accelerated provisioning that could happen for a quarter or two, and the P&L could take a hit. However, I think from the balance sheet perspective, the worst is behind. So that essentially is the hypothesis that is driving these large flows into banks like ICICI, Axis and SBI, BOB in particular, and some of the other PSU banks also follow suit. at the same time, the confluence of factors, I think, you had the negative factors, had dented the performance of private sector banks. In case of Kotak, I think the RBI's rejection of their preference share issue. In case of Yes, I think in my opinion, I think, the regulator ought to be cognizant of the impact of keeping an approval pending for nearly 2 months and bringing this kind of a surprise at last minute on thousands of small investors. I think because this kind of uncertainty doesn't spell well, I think from the investor's perspective. I think RBI needs to come out, in my opinion, very swiftly about either way, whichever they want to weigh in, but should not prolong this uncertainty beyond a few days, in my opinion. In HDFC Bank, we see it's a high-profile exit. So there's a confluence of factors in private sector banks that's come together and hit them negatively. However, the underlying pristine asset quality as well as consistency in performance still makes me believe that we should have a 60-40 kind of an allocation. 60% allocation should probably go to the retail-focused banks, but on the margins, I think 35 to 40% allocations should be considered into high-quality, preferably private sector focused, so corporate focused private sector banks rather than PSU banks, which are hampered even today by many requirement of capital or sort of lack of autonomy in terms of hiring domain experts, being not so fast in the embrace of technology. So there the preference will be on the private sector corporate banks.
Point taken, Ajay. Thanks a lot for joining us today. You have a good weekend and a more conversation.